Welcome to learnipsas.com. Today's topic, I will cover IPSAS 14 events after the reporting period. You will learn about adjusting and non-adjusting events. This will help you prepare accurate financial reports. Subscribe now for expert insights and practical examples. To learn IPSAS.com, your hub for accounting knowledge. Objective of this standard is to prescribe when an entity should adjust its financial statements for events occurring after the reporting date. The disclosure required about these events, including the date when the financial statements were authorized for issue. The standard also mandates an entity should not prepare its financial statements on a going concern basis if events of the reporting date indicate that the going concern assumption is no longer appropriate. So what is the scope? It applies to all public sector entities except government business enterprises. Business enterprises are entities that make profit like private. They compete like private entities. So most of the government entities, they don't make profit or loss. They have surplus or deficit. So the difference between GPs and other public sector entities is that the GPs make profit or loss like other private entities. Applies to all public sector entities except GPEs, which apply international financial reporting standards. Entities that prepare financial statement under the accrual basis of accounting must apply this standard. So we'll go to definitions. Events after the reporting date. What are the events after the reporting date? Events can either be favorable or unfavorable that occur between the reporting date and the date when the financial statements are authorized. It means the date when the financial statements are signed. Adjusting events. These are events that existed at the reporting date and necessitate adjustment to the financial statements. So they existed in the reporting date and the reporting period, and they necessitate adjusting or adjustments. Non-adjusting events are events that came after the reporting period. So there's no need to do an adjustment because they came after the reporting period. So sometimes we may see events that happen after, because a court case can happen, a determination can happen after, but the case itself happened within the reporting date. We'll see in our next slides. Authorizing the financials for issue. Determining the authorization date is crucial as it marks the end of the reporting period. So the reports are not naturally signed as at 30th June or as at 31st December. They normally take 2 months after. They normally come 2 months later. So the reports are normally signed 2 months later by the person concerned to sign those statements, either the CEO, the entity, the accounting officer, the PS, the ministry, any person who is concerned to authorize, sign after the approval by the board. The reporting date is the last day of the reporting period. For some entities, it is 30th June. Others, it may be 31st December. It depends from country to country. So recognition and measurement. These events can either be favorable and unfavorable. That's what you have said. So this can be adjusting and non-adjusting events. Entities must adjust the amount recognized in their financial statement to reflect the adjusting events. Example of adjusting events: settlement of court cases, confirming present obligation at the reporting date, receipts of information indicating an asset impairment at the reporting date, such as bankruptcy of a debtor, determination of cost of assets and purchases or revenue collected before the reporting date, discovery of fraud or error that show the financial statements were incorrect. Non-adjusting events, while not required adjustment, must be disclosed if they are material and could influence the economic decisions of users. Examples include significant decline in fair value, which is determined after the reporting date, natural disaster and takes over all the building, for example, flood comes and destroys the building, but after the reporting date, plan to discontinue or restructure, which came after the reporting date, dividend payment, which came after the reporting date. Condition existed at the end of the reporting date. So adjusting existed at the end of reporting date. Non-adjusting arose at the end of the reporting period. At the end of reporting period. So what to do? For adjusting, you include in the financial statement in the reporting period. So all adjusting events, since they existed at the end of the reporting period or within the reporting period and involves adjusting, you include in the financial reporting. Even if it is a court case, an employee takes you to court and wins that court, but it wasn't a liability when preparing the financial statement as at 30th June or 31st December. So after the end of the period, if the court case is determined the employee has won, then you include those events, the liability in your financial statements. For non-adjusting, if the nature has destroyed your building, or the fair value has changed after the reporting date, or you are paying dividend, you don't include in your financial statement. You just disclose. So you don't adjust your financial reports. Events that happen between the close of the financial year and before board approves the financial. So these events, you may have had the information between, sometimes it is 2 months, 3 months, depending on when the board or the CEO signs these annual financial reports. Some people sign up to 30th September, others 30th March, 31st March. So it depends from location or entity to entity. Dividends. If an entity declares dividends or similar distribution after the reporting date, these are not recognized as liabilities at the reporting date. Instead, they are disclosed in the notes to the financial statement. The reason being, such distributions do not meet the criteria of a present obligation at the reporting date. The standard requires entities to just disclose the nature of the event, an estimate of its financial effect, or a statement that such an estimate cannot be made. Going concern. If events after the reporting date indicate that the going concern assumption is no longer appropriate, the financial statements are not prepared on a going basis or when there are material uncertainties about the entity ability to continue as a going concern. So if IPSAS 1 requires disclosure when financial statements are not prepared on a going concern basis, or when there are material uncertainties about the entity ability to continue as a going concern. So if events after the reporting date indicate that the going concern assumption is no longer appropriate, the financial statements should reflect this change. This could involve revaluing assets and liability or recognizing additional liabilities. Disclosure. Entities must disclose the date when the financial statements were authorized for issue and who gave the authorization. Information received after the reporting date about conditions existing at the date, updating previous disclosures if necessary. Details of material and adjusting events, including the nature of events and an estimate of its financial effects. We conclude IPSAS 14 is effective for annual financial statements covering period beginning on or after 1st January 2008, with earlier application encouraged. It supersedes the previous version of IPSAS 14 issued in December 2001. IPSAS 14 ensures that public sector financial statements provide a true and fair view. We normally say true and fair view. So we are accountants and and many people depend on our financial statement. So we have to give the true situation and fair view of those reports, which we normally prepare by appropriately reflecting the impact of events occurring after the reporting period. This standard, or IPSAS 14, enhances the reliability and transparency of financial reporting, aiding our users or financial users in making informed economic decisions based on accurate and timely financial information. By understanding and applying IPSAS 14, public sector entities can improve their financial reporting practices, ensuring compliance with international accounting standards and maintaining stakeholders' trust. So there's no IPSAS that contradicts others. So every IPSAS complements other IPSAS. Thank you for watching. I hope you enjoyed learning about IPSAS 14. Remember, adjusting and unadjusting events are key. Stay tuned for more financial insights. Subscribe to learnipsas.com for more accounting content. Learnipsas.com, your hub for accounting knowledge.